Hello and welcome to the Weekend Investing DailyByte of 29th of January. Two more sessions to go before the budget. The market bouncing today. Relief rally for sure. We don't know whether this is an intermediate bottom or long-term bottom or just a short-term bottom, but nevertheless, a much needed relief in terms of soothing some, broken nerves and even 5% rally in many stocks after 25% of drubbing will give you a sense of some relief. So that has happened today. I think one should not read too much into this to the extent that betting on it as if it is the new leg up. It may well be, but it may not be. So it will take some time before you can really say with any higher probability that the market has started to go up. So this is just sort of a reactionary dead cat bounce, you may say. Once the structure for the leg up is confirmed, only then the probability of going higher can be said to be more reassuring. Today, we will talk about some data points that will shock you and probably can save you also from all this volatility in the future. So, do take a look at the second half of the video. I will not reveal too much about it. Uh, of course, read the disclaimer fully and subscribe to the channel if you haven't so far. Let's now look at the markets. Nifty, for the first time since 1st of January, or rather 2nd of January, has closed above a 2-day previous high. So we have now closed above the previous 2-day candle. This happened here. It was completely rejected. It can still happen here. It may get rejected, but at least it is the first glimmer of hope that maybe we are going to get a leg like this here. Uh, Nobody can say right now whether we will or whether we won't, but the probability is higher when a close above the 2-day high is achieved. That is just my observation, my way of looking at charts. A lot of times, for instance, here, it'll get broken down many times, but then most of the persistent rallies that happen above a 2-day high also do a lot of good. So the first filter, you can say, for me to look at whether market can go up has been achieved today, and there are going to be many more filters. We also need to go above this pivot to get more reassured. We need to have this average move up, a structure of higher highs, higher lows, and then going up. That probably will cement the potential of the up move more. So good day, 0.9% on Nifty. Nifty Junior also in similar space at plus 2%. It's a good move into this gap, not yet filled, but a 2% up move is always good. Mid caps not yet above today high, but a good 2.4% pullback. So a lot of folks who sold on uh, the drop on Monday and the drop on Tuesday, probably already feeling a little bit of a FOMO. Why did they sell it here or here? So selling at the bottoms usually will have that kind of a confusion in the minds of the people. So always have a strategy to sell. Don't sell just because you think markets are going to go dead from tomorrow. Uh, Small caps also gaining 3.1%. Again, this is a just a very small up move from this bottom so far. Is nowhere near even the major breakdown point that happened last week. So can't say too much about it, but nevertheless, I mean, it's a good move to have happened at this point 2 days before the budget. I think the next 2 days potentially should either go flat or slightly higher. That is my guess. Uh, Given that there is always, even if it is 2%, there is always a surprise element in the budget that is possible. Uh, Maybe the finance minister will have some nice dreams and maybe in a good mood on Saturday. 3.16% on small caps. Bank Nifty, which was running yesterday, gained 0.6%. So very much in a green zone. Last three candles from the open have been closing higher. This is a reasonably decent, I would say, outcome. it needs to really break 50,000 mark to really make sure we are going up. Advance decline ratio 444 advances, so a lot of stocks advancing today, only 55 declines in the market. Heat map all green, mostly green. Maruti down, Bharti Airtel down, and you had Asian Paints down. Other than that, you had muted moves on some of the banks, finance companies going up. The RBI pushing in liquidity, yields going lower are suggestive that some rate cut may come end of first week February. IT stocks jumping back up. Nvidia and all those companies that were drubbed two nights back have started to move back up again. Let's see how far they go. Other auto stocks, cement stocks, steel stocks, pharma stocks also did well. In the Nifty Next 50 space, you had a lot more green. Zomato was leading the rally at nearly 7%. TVS Motors up 5.5%. You had Siemens, ABB go up. Bosch, for some reason, was down. Maybe the results were out. Divi's Lab, Zydus Life, BHEL clocking 6.5%. PFC, RFC, IRFC all up. DLF doing well. Bajaj Holding, Chola Finance all doing well. JSW Energy also down post its results. In the sectoral trends, real estate really picking up very quickly, 2.9% again after yesterday's nearly 2.5%. So this week is now positive. The highest gainer in this week is real estate. IT stocks also strong, 2.6% today, again green on the week. Auto stocks doing 1.5% are also green on the week. Private banks are green on the week, 0.8% today. Bank Nifty overall is also up 0.9% for this week. So real estate, which was hit the most, has come back the most this week. You had FMCG, which is not performing at all. It is just stable there, not really going up or down. For the last 12 months, FMCG is now absolutely flat, 0% returns. And you had some minor gains in banks, consumption stocks, commodity stocks, etc. In the real estate space, you can see here the index is trying to pull back up. You had some big moves in Brigade, Mahindra, Prestige, Godrej, Raymonds, etc. So that's a good news for real estate stocks. I think a small intermediate leg probably can go and challenge this 950 level here. So let's now come to this surprise data that is designed to shock you and also to save you from future volatility. So, what is a typical investor's journey? They hear about other people making money in small caps. They enter, at the peak of FOMO in small cap journey. Then markets go through a fall like they are doing right now, and then they will exit the market. Maybe they already have, or they will in due course of time. That is the typical journey of a new investor. Somebody tells them names of 4 or 5 stocks, they will invest in those, or some FOMO of some kind will happen. This is story of not just few people. This is story of most people who will come to the market at least for the first time. Uh, they want the alpha in the small caps, but basically don't have the appetite. They don't have the right approach or expectation from the market, that what are they exactly expecting from the market, what is the instrument that they're getting in, what should be the time frame in mind before they reevaluate their decision, and what is the volatility that they're expecting. Nobody will tell all this, but what they will hear in the party is, I put in 100 rupees, now it is 500. I put in 20 rupees, now the stock is 70 rupees overnight. So that when you hear all those stories, you basically don't come across any of the reality of how it has to be done. So we are doing a data experiment here. Let's add some gold to your small cap investing and see the outcome, and you will hopefully be also pleasantly surprised to see the outcome. So okay, so one more episode on gold. You a lot of folks probably will say, why you keep doing episodes on gold. So we are not making any money from gold, but I just want to make sure that asset allocation becomes a thought process in your mind, even if you are a new investor, so that when you come to that level of investing where you can do some asset allocation, this is ingrained in your mind, that asset allocation is the real deal for a long journey in the markets. uh, let's now look at some data points. So we will take 4 or 5 peaks. There was a peak in December 2007 or January 2008. There was a peak in October 2010, and this is small cap 100 data. January 2018 was another peak. Then there was another peak in January 2022, and we have uh, the data till January 2025. So the first peak, 2007. From that peak, if you had only small cap 100 index, you would have made a CAGR of 6.3% till today. So from 2007 till 2025, you would have had to bear a max drawdown of 75%. If you had added 50-50 gold to this portfolio, just 50% gold and 50% to small cap 100, your CAGR would have been 11.1%, and your max drawdown would have been nearly 40%. Much lower drawdown, much higher CAGR. If you, of course, you had only gold, you would have still performed better than small caps at 12.3% and max drawdown 25.3. But let's not take that as the preferred example in this case, because we want to invest in small caps. Next market peak was October 2010. From there till now, the small cap CAGR is 11%. Max drawdown we would have had to suffer was 60%. If we added gold, it would have been 11.9, but max drawdown would have reduced to just 20%. And your only if you had gold, you would have gotten only 9%, 9.7, and max drawdown of 25.3. The volatility is reducing dramatically, as you can see. Then January 2018 was the next peak of small caps, where the highest FOMO was there for small cap investing. From there till now, we've had a 8.7% CAGR, poor CAGR. If you added gold, it would have been 13.9%, and pure gold would have been 16%. Max drawdown would have been 60%, which would have been dropped to 20% if you added gold, and pure gold only would have had 15% drawdown. Now the most recent peak of January 2022. From there, we are still up 12.9% CAGR. If you added gold, it would have been 17.5% CAGR. If only you held gold, it would have been 20%. Max drawdown of 25% would have reduced to about 11% only. And within gold, you would have had only 8%. So volatility dramatically reducing from 21% to 10% for this portfolio. Now let's also look. We've seen from the peaks. Now let's also look from the bottoms. Where would we have been if we were a bottom picker and we were precisely able to pick the bottom each time? That will give you a different perspective of the data. So 2004 May bottom, you would have made about 16% on small caps. Had you added 50% gold to it, you would have made 16.4%, and your drawdown would have reduced from 75% to nearly 40%, as in the prior case. Just gold would have given you only 13.3. So mixing small caps bought at the bottom with gold really gave a lot of benefit. Volatility almost halving there. From March 2009 bottom, you had a CAGR of 16.5% on small caps. By adding gold, it would have reduced to 15%. Gold from March 2009 has given only 10.5%. Max drawdown would have dramatically reduced 60% to 20%. On pure gold, it would have been 25. Volatility reducing dramatically again. Market bottom of 2013, CAGR from there over the last 11 odd years would have been 17.5%. So fantastic CAGR from that bottom. If you added gold to it, it would have been 14.5%. Max drawdown would have reduced from 60% to 20%. Volatility reducing dramatically. And from March 2020, the COVID bottom, just small cap investing would have given you 36.9% CAGR in small cap 100, even after this current drubbing that we have had. And a max drawdown of 25% only. If you had added gold to it, it would have reduced to 26.9%, still very impressive, but max drawdown of only 11% versus 25% here, and volatility almost halving there as well. So you can see the benefits of adding asset allocation and especially gold here in this perspective, from the worst entry points to the best entry points, and in all of them, volatility and max drawdown gets dramatically reduced. From the peaks, CAGR gets dramatically improved, and from the bottoms, of course, because they were the best picking points, the returns are slightly lower. So it is a great way to improve the CAGR, because we are not picking the bottoms. We can assume that we will be somewhere in the middle on average. We will certainly lower the drawdowns. We will lower the volatility, and we will have a much smoother, much more calmer, peaceful, portfolio going forward. So this 50-50 portfolio has done very well, coming close to small cap returns at most places with lower volatility and lower drawdowns. This is the core or the crux of it. Right now, also you can see from August, for instance, small caps are down 14%. Gold in INR terms is up 18%. This negative correlation is almost perfect, and that's what gives this fantastic results whenever you add gold to your equity portfolio, whether it is large cap, mid cap, or small cap. But especially with small caps, because of the high volatility, this really plays well. So now I hope you are able to appreciate better the role of gold in your equity curve. Let me know in the comments about your thoughts, and do like and share this video. Do subscribe to the channel if you haven't so far. I'll be looking forward to your comments. Thanks. Bye.